Welcome to the Banking with Life podcast. I'm your host, James Neathery, and I'm excited to share with you that we've created a new series. This is a topical series where we've taken previously recorded clips, compiled them by topic, idea, and particular concepts within the infinite banking footprint and the financial world broadly. Topics will include loans, loan repayments, paid up additions riders, other riders, dividends, long-term thinking, what could go wrong, what does go wrong within the infinite banking footprint. And I hope you enjoy listening. And it was created for your edification. Thank you. This question, why does a death benefit decrease at a particular age in the future? And I would say that it depends on many things. Either the policy was designed for a reduced premium in the future, or you're not making a premium repayment and there's no illustrated, premium being made. But if you're constantly paying a life insurance premium, the death benefit would continually or should continually go up. But that depends strictly on the structure of the policy. The short answer is either the policy was designed that way or premiums are not being paid in the future. What if at a given time I can't pay my premium? We'll do something about it, right? You want to be able to pay a premium, but if you can't pay a premium, your policy may have cash values. You can, depending on the cash values and the time period, if I can't pay a premium in year one, I might not have should have bought a policy. Right. If I can't pay a premium in year 2 or 3, I might not should have bought a policy. Right. If I can't pay the premium in the future, I want to change it. Number one, I want the ability to pay a premium. But if I have cash values, I can withdraw and pay a premium. I can cause a policy to premium offset or pay its own premium. And I don't know, maybe I have to sell some other assets, to make a premium payment. And this is kind of I think this is a reply to a question that was asked on an episode, okay, or a video that's released on our channel. And so the video is the basics of infinite banking, quote unquote, a seminar at a private real estate club. Okay, so the statement here says, no, you don't borrow the insurance company's money. You are borrowing your own money, period. The reason why this is true is because when you borrow a sum of money, your death benefit is reduced by that sum. You will never be able to borrow more than the value of the policy. If you do, the policy will be canceled, and the insurance company will keep any residual cash value in the policy. Man, Prima, that's a swing and a miss. That's somebody that thinks they know something and they're trying to explain something that they're not really clear on. And that's exactly why this comment wasn't released. It'll be released in addition to this Q&A episode, okay? So you are actually, in fact, literally, legally, technically, and actually borrowing the life insurance company's money, period. Whether you agree or disagree. Whenever you pay a premium to a life insurance company, that becomes their property. You paid a premium. There's an exchange. You paid a premium, they assume the risk of death. Period. Now, if you paid your automobile insurer a premium, is that your money? Crickets. No, it's their money. All right. So, in fact, the premium payment is the life insurance company's property. Now, the life insurance company has to take that premium and net of all their expenses, distribution, mortality, actuary, they have to put the residual, the net after expenses, to work. All right. Okay, why? Because the death benefit and the future cash value is an obligation to the life insurance company. So they have to put those premium dollars to work to meet their future obligations. Now, when you have dividend paying whole life insurance, you have a cash value. Now, that cash value is not yours. It belongs to the life insurance company. You have a contractual right, if you have a loan provision and a life insurance contract, to collateralize that cash value. So you're collateralizing the cash value and you're borrowing the life insurance company's money. Period. Okay. And then you say the reason this isn't true is because when you borrow a sum of money, your death benefit is reduced by that sum. Well, that statement is true, that when you borrow, your loan reduces the death benefit. Well, that's because the cash value is the net present value of a future death benefit. Okay? So words have meaning, and I'm trying to simplify and convey what's really going on, but words do have meaning. So, okay. You will never be able to borrow more than the value of the policy. Well, you'll never be able to borrow more than the loan value of a policy. So what is the value of a policy? Well, when you graduate, the value of that policy that is paid to your beneficiary is the net death benefit. While you're alive, what is the value of that policy? It is the surrender value, which is always typically larger than the loan value, right? So you have a loan value. You cannot borrow 100% of your cash value, right? You can't leverage 100% of your cash value. Here I'm saying words have meaning. So if you have a cash value of $100,000, your loan value is going to be less than that. Why? Because these mutual life insurance companies are uber conservative. There's internal reserving that goes on. All right. So they're going to act like you're not going to repay the loan. They're going to act like you're not going to pay the interest. They're going to act like you're not going to pay a future premium payment. So they reserve internally. And then you go on to say, if you do borrow more than the loan value or the surrender value of your policy will be canceled. It will lapse. To cancel a policy, you, the owner, has to cancel the policy. Okay? If you do not pay a premium payment, then typically if there are cash values, the policy is going to pay its own premium internally. It's going to start cannibalizing itself, and it will do that until there are no cash values to pay premiums. That is considered and called correctly a lapse. Okay? All right, the insurance company will keep any residual cash value in the policy. No, they don't keep anything, right, except their profits. But, so here's an example, and I can create a ton of examples. If I have a $50,000 cash value and I don't pay a premium, internally that policy is going to pay its own premium. If I live long enough, it is theoretically possible and actually possible for that policy to cannibalize itself. It is also theoretically possible for that policy to continue and be enforced when I graduate. Right? There is no residual cash value that the company keeps ever. Why? Because the cash value is the net present value of a future death benefit. It is part of the death benefit. Okay, I hope that helps. And the question is the cash value the death benefit? Question mark, question mark, question mark, question mark. I think for emphasis. Dexter, listen. The cash value is the net present value of the death benefit minus future premiums. So whenever I graduate, that maybe I have a $50,000 in cash value, but $250,000 in face amount when I graduate. When I die, when I graduate, immediately that $50,000 turns into that death benefit. That death benefit is comprised of that cash value. So the cash value, though, is the cash value. That's what I can get mad and quit and walk away with, or that's what I can collateralize while I'm alive. Right. And by contract, the cash value must equal the death benefit at age 120. So it's distinctly different. The cash value is the cash value. The death benefit is the death benefit. In terms of today, I have access to the cash value. My people are going to enjoy the death benefit. Right. So I hope I'm clear on that. The cash value is not the death benefit. It is the net present value of the future death benefit minus future premium payments. All right, so in a sense, you could say, well, yeah, the cash value is absolutely part of the death benefit. All right. But, I kind of want to talk about this because I see and hear often that, I'm borrowing against the death benefit. No, you're borrowing against the cash value. All right. So, but there is a distinction between the two, but there's an absolute relationship between the two as well. I hope that answers your question. And thank you for listening. How do you determine how much you can take out, quote unquote, as retirement income? For example, on page 54, becoming your own banker, how is the first withdrawal of $92,000 being supported? Well, that's a very good question. How do you determine how much you can take out? Well, you determine that by how you're taking the income. Are you withdrawing from the policy values, or are you borrowing against the policy values? And so you determine how much you can take successfully. When are you going to die? Don't know. But there'll be some work that your agent would do. It says, look, you can, if the dividends don't change, you can take this X number of dollars out each year until you're age 90, 95, or 100. Right? So you got to pick a time period. And it does matter. You want that policy in force when you graduate. Okay. So you don't want to cannibalize that policy. And Nelson's example on page 54, where he's taking out $92,000, I believe that's in equipment financing. What page? 54. Yep. So, if you haven't had the opportunity to hear Nelson live, you can hear him, recorded on a DVD series. And he explains, and he used to explain all the time, is how he determined the income in all of those illustrations. That's illustration number 1 in equipment financing. And the way Nelson determined that, and he would tell the story about the artillery range and the expendable, corporals in the military, and, firing for effect, and just the range finders. And it was a great analogy. But he determined the income based on that death benefit, right? So if you look at the death benefit, this is page 54, illustration number 1 in equipment financing. He started taking out $92,000 at the end of year 36, age 65. So he's year 37, age 66. But if you look at the death benefit, way over there in the far right column, he has $2.388 million in death benefit. If you go down to the very bottom, Nelson killed him at age 85, and the death benefit is $2.4 million. That's how Nelson determined the income in each of those illustrations, is he kept the death benefit relatively equal. So he could have taken more income, right? These are withdrawals. These are not loans. He could have taken more income, and the death benefit would have been less at age 85. He could have taken less income, and the death benefit would have been greater, right? So how do you determine? It depends on your circumstances. That may be more than you wanted to know, but I had fun reminiscing. So I hope that helps. You determine how much income you need at the time. The future is unknown, and how you're going to manage that policy once you start taking income from that asset. In this question, what is the idea behind the accelerated death benefit rider? The definition is written in Insurance Ease. I'm not sure that I understand it. An accelerated death benefit rider, and there are many across the industry. Every company has their own or multiple. And typically just the accelerated death benefit, it allows you to receive a portion of a death benefit if you meet certain requirements, like you're diagnosed to die, or you're likely to die. You're diagnosed with a terminal illness and your life expectancy has been shortened. That would trigger most accelerated death benefit riders. And then in addition, the life insurance companies across the industry are moving away from long-term care, quote unquote, and extended care, whatever that terminology is, to an accelerated rider. Maybe an accelerated, rider 2 or plus or additional, which allows you to access some or all of the cash value and some or the majority of the death benefit if you meet certain requirements. Can't perform 2 out of the 7 activities of daily living, which is long-term care language that triggers long-term care benefits in the long-term care world. Or maybe you have some kind of dread is heart attack, life-threatening cancer, stroke. There's triggers to access the accelerated benefits, right? Terminal illness, a specified disease, or chronic, whether it's chronic, I got to go to the nursing home, got to have home health. A chronic illness could trigger benefits as well. In this question, what is the idea behind quote unquote surrender to pay premiums? It looks like the premium outlay goes to zero, and I don't really understand that. Okay. So and I kind of spoke to this in the previous question, if you have cash value and you have sufficient net cash value, net of any outstanding loans, net cash value. If you have sufficient cash value there, you can surrender cash values to pay premium. That's what surrender to pay premium is. You're surrendering cash values to pay a premium. And that's typically not a permanent option or ability that a policy owner would have. But that's what that means. You're surrendering PUAs to pay a premium. And Nelson used surrender to pay premium in some of his illustrations and becoming your own banker. So you surrender the cash values typically from the PUA, the base premium and the riders, whatever, are paid. Dividend is paid on that premium payment. But the premium payment to pay that was using surrenders of cash value. I hope that answers your question. And a good question it is. Okay. In this question, what is the reason for a term rider? Is it used to hold a level death benefit? Question. There must be a reason other than the death benefit itself, since death benefit is not really emphasized within the infinite banking community. And I modified that question for this episode, but that's exactly what he's asking. And so typically a term rider is used to raise the death benefit to avoid a MEC. And it's either a rider on that policy is a standalone term rider, or a lot of companies have blended PUA riders that blends the PUA with a 1-year annual renewable term component. There are multiple PUA riders across the industry. They're all a little bit different. We have released PUAs 1 and 2 as standalone episodes. Part 3 will come out in the near future, and it will dive deeper into the death benefit. So it'll come up in there too when I'm talking about blended PUAs.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.